We're joined now from our Cape Town studios by Abdul Davids, Head of Research at Kagiso Asset Management, to discuss Kagiso's PMI index, which came in at 50.2 for the month of December. Clearly nothing to be excited about, Abdul, but when we put this in correlation with the November manufacturing numbers we saw as well, which took a bit of a dip, does this bode well for the South African economy?
Yeah, I think what we have seen is continued rebound from the strike-affected months that we saw early in the year, in 2014. The good news is that the fourth quarter average is significantly higher than the previous 9 months average, so it does bode well, hopefully, for the first quarter of 2015.
That's an interesting point, that the index, in fact, fell again here, but it is still above 50, which I guess is not a bad place to be.
That's right, and what we have seen is that we believe that a lot of the business activity drop-off that we saw in December was mainly attributed to the load shedding that we saw starting in late November and then obviously continuing into the month of December as well. Bearing in mind that your Christmas trading for retailers is quite a significant period, a lot of the manufacturers that supply retailers would have been affected by that in terms of stock holding, warehousing, etc. So sentiment was clearly affected by that, and we believe that in the absence of any load shedding, we could have seen a much better performance in December as well.
I'm sure you listened to our earlier discussion, Abdul, with regard to the impact of Eskom and the oil price on South Africa's economy going forward. If it is such a dismal outlook, what does this mean for PMI?
I think the fuel price decline that we have seen is probably the single significant and most positive development that we've seen for manufacturers in a very long time. In past sort of programs, we have discussed that oil and energy make up almost a third of manufacturers' cost basis. So clearly the impact of much lower oil will be quite beneficial and will help improve profitability for the sector. So I think that obviously juxtaposed with the fact that we have load shedding and we're likely to experience further load shedding is obviously offsetting some of the benefit that we will see from the low oil prices coming through.
So give us an idea, take the scales, and on the one hand you've got the lower oil price, on the other hand you've got Eskom load shedding, unable to deliver electricity. How does it stack up together, positive or negative?
I think at the moment the load shedding and the blackouts, they happen on schedules, and you've got the stage 1, stage 2, etc. So from that point of view, I think it's not as bad as 2007, where it was a lot of unplanned outages. And the difficulty for manufacturers is that you can't really plan your business around not knowing when the lights will go out. So I think the uncertainty around it, admittedly at the margin, it's negative, but at least you can plan around it. Whereas the fuel price is a general reduction in your cost base. So I think the price drop that we've seen in terms of fuel prices is much more significant. Having said that, I think if we do see an increase in the frequency of load shedding, it will be quite detrimental, because clearly with every day of load shedding, you've got revenues that you're losing, which is a substantially higher number compared to your cost number, typically for manufacturers.
But you haven't answered my question, which is, which way does it balance of the two? Is the oil price reduction a net after taking Eskom out of the equation something very positive for this economy?
I think so. I mean, as you said in your earlier discussion, we are a net importer of fuel, and it obviously put a lot of strain on our ability to fund our fuel purchases, given where the prices were historically. Some of that benefit is lost with the higher currency, and the currency obviously being at quite weak levels, above 11.50. But I think a drop from 109 last year to $45 currently, that is quite significant. And on a net basis, it is quite beneficial for the economy.
Abdul, we also have you in our Cape Town studio to talk about education stocks. One obviously thinks about Cura and Advotech, given the fact that it is the first day of school, that surely there's a lot more growth potential to those particular stocks.
Yeah, I think in general, I mean, we look at the education sector as a growth sector. I think both companies and some of the unlisted companies has a lot of growth potential. We know that the issues that we've had with our matric results last year, the quality of education in South Africa in general, and people willing to pay a premium. It's almost like medical care and medical aid. We're willing to pay a premium for quality, and similarly with education as well. I think if you look at Kuro, it's been a fantastic story in terms of their growth. Listed at around R5, it's basically gone up 6-fold. And clearly the growth that they've experienced, I think for this year they're looking at over 10 schools that they're looking to open this year, and looking to double from their current base by 2020. So I think there's a lot of room for the whole sector to grow, given the weak sort of public sector experience. And I think they make fantastic sort of growth stories in terms of the earnings profile. Having said that, I think valuation is obviously critical, and one has to look at valuation relative to the growth opportunity set as well.
And when Leslie Marstorp came in to begin with at Advotech, there were many who were a little skeptical. He certainly has ratcheted up their growth opportunities. Given the rating is a lot lower still than Curro, would that be the pick of the two?
I think everyone has to look at education. As I said, obviously one has to look at the growth opportunity set. On a valuation basis, you're comparing almost similar numbers, I think, in terms of student numbers. The one is a 3.5 billion market cap, the other one is close to 10 billion market cap. And clearly that tells a story in itself. But I think obviously there's a lot of nuances. Both companies are making acquisitions, in the process of bidding down acquisitions as well. So there's a lot of noise in the numbers, but on the face of it, we have seen, and Curro is a good example of that, substantial growth in terms of the number of enrollments. The pipeline is also very strong. They've had the rights issues, and I think from here, clearly the market is rewarding them for significant growth into the future. We would just be hesitant on Curro given where the multiples are. I mean, obviously, if we look at the P multiple, it's well above 150, for example. So you need to have compounded growth continuously for the next couple of years to justify the current rating.
Thank you so much to Abdul Davids, Head of Research at Kagiso Asset Management.